Webinars. Today it's AIFMD Remuneration Code, Regulatory and Tax Implications. My name is John Wilson and I'll be hosting this afternoon's proceedings. With me to present and discuss the AIFMD Remuneration Code today are Bobby Jahal, who's Head of Technical at Cordium, and he'll provide us with an overview of the code itself, the requirements, FCA guidance and some of the challenges that managers are facing. Bobby will then be followed by Lawrence Parry, who is our Head of Private Client Tax at Cordium. He'll discuss some of the taxation challenges presented by the introduction of the code, complications for LLP members, and when remuneration isn't remuneration at all. And also on the webinar from our Malta office is Adam Domenico, who will guide us through how the Malta Financial Services Authority is implementing AIFMD and whether Malta offers a possible solution to those regulatory and tax trappings around AIFMD remuneration that we'll be discussing in the UK. Now, after the short presentations, we'll spend some time discussing some of the more hidden challenges presented by the Remuneration Code under the heading, what the code doesn't say. And then I'll pose a selection of questions from the audience for today's webinar. So please do send the questions in using the webinar interaction facility. Although you won't be able to see the questions yourselves, we'll see them here centrally, and provided they're not too specific to your own individual circumstances, we'll try to answer. We're also happy to follow up any unanswered questions after the webinar. We'll also be circulating slides of the presentations to all attendees after the webinar, so there's no need to ask a question about that. So, once a firm is authorised under AIFMD, it will be subject to the Remuneration Code as set out in SYSC 19B of the FCA handbook. However, the full AIFMD remuneration regime, and specifically the payout process, only applies to the first full performance period after authorisation. So many firms are not going to be affected until they're calculating pay awards in 2016. But 2016 seems a long way off. The rules are complex and tax implications mean that firms will need to be considering early how they structure remuneration payments. Bobby, can I ask you first of all to remind us what the rules are, why they've been introduced, and how firms are likely to be affected?
Thank you very much indeed, John. So in my little session, I'll be running through the high-level obligations introduced by the code, by the AIFMD Remuneration Code specifically, of course. So to begin at the beginning, the remuneration requirements are set out in Article 13, Annex 2 of the AIFMD itself, and the rules closely follow those originally proposed in the CRD and to come in the MiFID and UCITS 5 obligations, but with some interesting differences which we'll go into, but all, of course, with the same underlying principle, and that is to say that in all cases that the remuneration policies and practices must be consistent with and promote sound and effective risk management and do not encourage risk-taking. The rules, as John mentioned, are subject to a transitional, but did actually come into play in July 2013. But they are, of course, again to repeat, subject to the overall AIFMD transitional provisions, as well as a particular one pertaining to the application of the payout process rules. They feature in SYSC 19B, and the rules specifically do not apply to sub-threshold AIFMs. The rules were provided some important flesh by both the ESMA and FCA guidelines. So, in the FCA's implementation that's featured in the FCA rulebook, there are 9 principles which set out many things, including detailed governance arrangements, listed on the slide here. So, very important part of those is the management oversight. So, and the management body in its supervisory function must ensure that and indeed it is responsible itself for the establishment, oversight and annual review of remuneration policies and practices at the firm. As part of that process, the control functions in the business, that is to say key players, business heads of the different units, should all feed into that process. Where commensurate with your size and scale, there should also be a remuneration committee. That's the guidelines suggest that should be considered as good practice where possible, and also should feature a non-executive director, which of course may present some problems for the managers of a certain size, but so that should be considered as good practice, but subject to the scale of your business. Also, very importantly, the management body should ensure independent annual review of the policy, and that's obliged in the rules. and of course, needless to say, large firms should have the resources to ensure that independence, and smaller firms may want to consider externally commissioning that review as appropriate. And of course, importantly, there are important risk alignment provisions within the scope of the rules. And a key part of ensuring meeting those standards is, of course, your remuneration policy, and that should be, needless to say, in line with the business strategy, objectives, values, and interests of the AIFM. That's under the Principle 2 of the SDA implementation. It should not encourage risk-taking, as compared to the investment policy of the AIFs managed. That's an important feature, and the comparison of the two. And it should enable the AIFM to align interests of the AIFs and their underlying investors with those of the AIFM itself, to achieve and maintain a sound financial situation, as is currently the case with the CRD, and should cover the range of remuneration instruments that you have, including pension, severance, personal hedging. So that's an important provision there. There's no clever PA dealing allowed, or the purchase of interesting insurance contracts that may compensate for the downward adjustment of REM. Important features. Skipping along, so there are important and specific risk alignment provisions in the code itself. The rules require that firms consider quantitative financial measures and qualitative non-financial measures over a multi-year framework for truly risk-aligned remuneration practices. The structural provisions are also referred to as the payout process rules, which were applied, which we'll come to shortly, require the, as is listed on the slide here, the deferral between 40 and 60% of variable remuneration between 3 and 5 years, and also the payment of at least 50% of variable remuneration in instruments other than cash, and also the application of fallback and malus as appropriate. The rules also oblige there's also rules around the limiting of guaranteed bonuses. Again, that's as is the case with the CRD. But particularly importantly, there is a provision in the code as it stands, whereby the provisions can be disapplied. So the payout process rules can be disapplied for an individual where the bonus that they receive is no more than 33% of the total compensation, and both conditions, and where the total comp is no more than 500,000. So I would imagine that would take a number of players out. So of course that does present a significant risk governance challenge, some of which we'll go through as we proceed through the presentation. So what's remuneration is covered? Well, it's really all forms of remuneration, all forms of payments and benefits paid by the manager itself, the AIFM, or the AIF, in exchange professional services rendered by all staff, but in particular by identified staff or code staff, as they're called. So any amounts paid by the AIF, including carried interest, but not importantly, not returned on investments, and any transfer of units and shares in an AIF is also covered. The fixed or variable components can include a range of things, as noted on the slide, such as cash, shares, options, contributions, all covered. And to repeat myself a little bit, remuneration directly received from the AIF, including carried interest models, also all included. Interestingly, what is excluded within the definition, and we'll go into a little bit more detail a bit later on in my little section, but what's excluded are dividends or similar distributions received by the owners of the AIFM, but of course, needless to say, only where such do not circumvent the rules, of course. Any ancillary non-discretionary payments and benefits which are part of sort of firm-wide, AIFM-wide policy that pose no incentive effects and in terms of risk redemption can be excluded from the risk alignment or payout process rules. Also excluded pro rata returns on investments, but there has to be an actual disbursement is required to meet this exemption. And importantly, loans made, as it reads on the slide, loans made to facilitate co-investments not covered within the exemption if the loan has not been reimbursed before the return is paid. That's an important provision The scope of the Remuneration Code, it applies to all staff whose professional activities have a material impact on the risk profiles of the manager or of the funds managed. Identified staff, or as they're known, Remuneration Code staff, include senior management, including non-exec directors, to the extent that they meet that test. Control functions, that is to say staff responsible for compliance, risk, audit, and other key business heads, and risk takers, so expressly the portfolio managers themselves also. And any other staff that exert a material influence on the risk profile of the firm, or indeed the funds managed. And also, finally, any employee remunerated in the same bracket as those above. So people will recognise those sort of distinctions from the those descriptions from the TRD. An important clarification that's provided in the ESMA guidelines confirm that the control functions variable remuneration is based on function-specific objectives rather than not solely based on function-specific objectives, so they can be remunerated in accordance with the performance of the firm itself, which was a slight ambiguity in the original drafting. So in terms of scope, again, continuing on the scope, the rules contain provisions around the delegation and the delegated application of the rules. So the requirements are extended to those to whom functions of risk or portfolio management have been delegated, and that's the UK position at least, as we'll talk about shortly. That there is a slightly different position elsewhere in Europe, and notably, namely in Malta. So to meet that condition, so delegates to whom to perform risk or portfolio management must be themselves regulated under comparable rules, or, if that's not the case, requirements should be stipulated in contractual arrangements that cover any payments made to the delegates as compensation for the services provided, and that's the staff in particular rather than the delegated entity. And the obligations are live as soon as the AIFM is authorised. So importantly, the FCA's long-awaited guidance on the implementation, that practical application of the Remuneration Code, published in Jan 2014 and built considerably upon ESMA's guidelines, and seemingly sought to ensure that, or to reassure that remuneration provisions can be applied in a proportionate way in accordance with the risk and complexity of a firm, of course. So that the key challenge remains the way in which managers would have to comply. Rather, the key challenge that the guidance sought to address was the way in which managers would have to comply with the payout process rules. So they're featured again on the slide there, just in way of reminder. But the guidance does allow the application of those requirements in a way that is proportionate, and the way it does that, crucially, is the question of the assets, the level of assets and the management of the manager, and that's presented as a key presumption on the question of a manager's systemic importance, and may provide, as the FCA terms it, a rebuttable presumption for the disapplication of the payout process rules, and also the requirement to have a remuneration committee. So, whilst the way the guidance has it, the disapplication is never automatic, the guidance provides a baseline position for considering whether a firm is a significant AIFM, and those guidelines, those baseline AUM levels are set out there. So, effectively for private equity managers and vehicles that are unleveraged with a 5-year lock-in, it's 5 billion, and 1 billion for all other types of firms. So, and importantly, the AUM here is based upon your net asset value rather than the gross or commitment method set out in the level 2 text. So, and importantly, it's an important calibration, if you will, introduced in the guidelines. The AUM is not the only measure. A number of other factors may be used to calibrate your response to the application, or perhaps more interestingly and importantly, disapplication of the payout process rules, even where a firm exceeds the benchmark AUM thresholds. Those other factors are listed on the slide there, but the guidance goes into some detail on the nature of these. So just to repeat what's on the slide, the number of code staff is important in assessing the type of structure that you have. The organisations and the ownership structure of the firm itself is considered to be important, and whether or not the manager is listed or not. the number of funds that you manage and the strategies deployed. The FCA's prudential categorization of the firm itself is an interesting indicator of your systemic importance, if you will. The nature of any delegation agreements you have, certain fee structures that you employ, and also interesting what other peer firms are doing as well. So in the application of those other factors, the FCA provides interesting supplemental guidance in the form of very helpful worked examples that, in short, show how the AUM need not necessarily be the decisive factor of the payout process rules. And to that extent, examples 3 and 4 are particularly interesting. So in example 3, a full-scope UK AIFM that manages 3 AIFs, investing in global macro strategies with AUM of approximately 800 million in sterling. Taking that into account, the fair presumption would be, reads the FCA guidance here, that the firm could disapply the payout process rules. However, the firm itself, in the FCA scenario, ascertains that it has fewer staff than some of its competitors. Its internal organisation involves external stakeholders as it's part of a group, which itself is listed. With respect to its activities, it also carries out the additional MIFID services, so it's a CPMI in the FCA's prudential categorization. Its global macro strategies are deemed to be complex and use significant human capital, including economists and analysts and programmers, computer programmers. It's 10 times leveraged, which that's under the commitment approach, which the guidance suggests is highly leveraged, and that meets, of course, the times 3 highly leveraged baseline mentioned in the AIFMD. And the returns is considered to be extremely volatile and intended only for investors with high risk appetites. So in that scenario, the FCA would expect, in actual fact, the firm to apply the payout process rules despite the size presumption, on the grounds that the firm is considered to carry out complex activities, namely managing highly leveraged volatile AIFs on a cross-border basis. It's part of a listed larger group, which makes its internal organisation more complex. Conversely, example 3 illustrates the case of a significant AIFM in terms of size, but where the size presumption can actually be rebutted, as I say, conversely. So in this scenario, the firm manages several AIFs, investing in equities, including trusts, investment trusts, as well as open-ended structures. Its AUM is around sort of 2 billion. However, upon further consideration of its size and its structure, the structure in this scenario is suggested to be straightforward, as it's owner-managed. Its activities are deemed to be non-complex because there is limited leverage. That's only for bridging purposes in this scenario, and then that's never more than 1.5 times the value of the NAV of the fund itself. The portfolios have strict investment guidelines and also are considerably diversified, and the firm strives to limit the volatility of its portfolios in this scenario. And there is also the funds do not carry any performance fees. Do not pay any performance fees. So in this scenario, the presumption is that they would have to apply the payout process rules given its size. However, the FCA concludes that given its non-complex activities, it's namely conservative, low volatility strategies, it's not listed, it does not have significant external ownership, therefore it's not deemed to be risky, and therefore the payout process rules can be disapplied. So the scenarios make for very interesting reading and are a very useful insight into what the regulator expects and the regulator's expectations overall. So I'd strongly recommend that firms review them carefully when calibrating and rationalising and importantly documenting your own response. So the key thing is that if you can show that your remuneration is truly risk aligned, and the rules do provide here, and the scenarios do set out the possibility for disapplication even where the AUM presumption does not work. So moving on to come back to the issue of delegation and some interesting guidelines that the guidelines introduce. The UK position, as mentioned, is in short that those firms that do delegate investment management services to external managers, as long as those external parties are captured by the CRD, and therefore the FCA's SYSC 19A or C rules, the FCA consider those other remuneration obligations to be effective for the purposes of the AIFMD, equally effective for the purposes of the AIFMD. However, it's important to note that the objective of the regulatory regime here is not direct equivalence of the rules, but the effectiveness. So the regulator seems to be open to any non-European directive-driven rules in this respect. Not that I don't think there are any at the moment, but the regulator is alive to those scenarios. And further, there are a couple of additional scenarios in the guidelines which show how the delegation provisions may be applied to third country delegates also. In one scenario, scenario 5, in actual fact, the UK AIFM delegates portfolio management to a non-EA sister company, and the firm, the AIFM puts in place contractual arrangements which require the delegate to implement CRD remuneration requirements for the making of payments to the group itself. So that would meet the FCA's equivalence test. So it's really worth having a look at those scenarios 5 and 6 again for understanding how the FCA might view delegations within group structures. So moving on very swiftly as I'm rapidly running out of time. The guidance draws attention to the attribution of in respect to partnerships. The FCA is of course aware of the long-standing issue that partnerships and profit shares and distributions are not readily classified either as fixed or variable remuneration, and it is to the variable remuneration elements of remuneration, of course, which most of the rules here are applied. So the guidance provides terms of what it calls approaches for the attribution of drawings between in-scope fixed and variable compensation and potentially out-of-scope profit share. So an important step, of course, here is that once you've considered who your code staff are, the only staff to whom the payout process rules need to be applied, consider which remuneration is a form of payment in exchange for professional services rendered. So the approach, the approach one can take is based on existing payments to partners and consider how partners are currently awarded. So distributions made to owners of the firms may be excluded as a pro rata return on investment in the AIF. Drawings taken in advance are generally considered to be fixed remuneration, and discretionary profit share distributed to all may be considered variable remuneration. And further, additional profit share paid to founding or senior partners that is over and above what is paid to other partners may be considered out of scope, especially if there's an automatic allocation. So drawings taken in advance may be considered as fixed remuneration. And firms should also consider what their peer groups are doing also in this respect. The guidelines go into some further detail about some other considerations, and importantly, one also needs to consider the amount of time a staff member spends on AIFM activities, especially where there are mixed services provided by the group, or by the entity in question. And there's also an important requirement that your fixed and variable components of the remuneration must be appropriately balanced, but that the FCA is proposing in the current consultation to remove the requirement to actually set a ratio, because that's not obliged in the directive. So I'm sorry to skip ahead slightly just as we're running slightly short on time. So just in closing, on disclosure points, there is a significant disclosure requirement in terms of AIFMD disclosure. It's similar to the CRD, but it's more prescriptive. And that disclosure should be included in the annual report of each AIF, or indeed a standalone document that accompanies an annual report. And that needs to include a general statement on your remuneration policy and information on rewards paid by the AIFM to its staff, including total comp and split between fixed and variable compensation, and the number of recipients and any carried interest paid. And of the above, the aggregate amount of remuneration attributable to risk takers, so significantly increased amount of data required in this disclosure. It's not a public disclosure technically, but it needs to be made to your investors and also to the regulator if they should ask for it. And again, the overall proportionality principle will apply. So there are lots of very important next steps to take in consideration of what one needs to do. Racing through these rather swiftly. Consider the need to review existing remuneration arrangements. Then consider the need for external review. Review your delegation arrangements. understand the scope and identify your code staff, and of course understand what might be characterised as in-scope remuneration and out-of-scope remuneration, and review your governance arrangements within the firm itself, and also bear in mind any commercial issues that might be arising, whether or not you think investors may come to expect implementation of the payout process rules, for example, and any issues around staff retention if you have to apply the payout process rules. And also, very importantly, if you need to apply those, seek tax advice, which Lawrence will share with us just shortly, and any legal advice.
Thanks, Bobby. That's very useful as the background there to the requirements. We are getting questions through, so please, which is the process is working, so please feel free to put any questions through, and we'll seek to address those at the end of the session. Now, I do know when it comes to remuneration, often the first question is, so what's the implications there for tax? I know the FCA has been working hard with HMRC to work out how those rules will be implemented. So, Lawrence, could you take us through some of the tax implications of all of this, please?
Certainly. I mean, what we're talking about here, really, is we're focused on deferral elements. Any element that's paid in cash or within the 6 months will be taxed under normal rules. So it's a deferral element, particularly that 40-60% that's deferred, of which 50% must be in units or equivalent. So we're looking at 20 to 30% of variable remuneration paid in some form of units. And how those deferral elements in units is taxed depends on the structure of the manager. Are you a corporate manager? Are you an LLP? As Bobby said, the concept of remuneration, apologies for my how I say the word, is important. The return on capital isn't remuneration, and it does depend on what you're doing now if you're an LLP. So there might be considerations as to reviewing your procedures now for the leading up to AIFMD going live for you. So deferrals in the form of fund units. Now, most of these will be units in the AIF. However, there is the possibility, depending on the circumstance of the manager, it might be in the manager itself. And if it's in the manager itself, it may be options over the manager, it may be options over a shadow portfolio or a shadow fund. And that has different tax consequences and also different tax opportunities. The bad news is that it's all going to be taxable, almost certainly. Now, the question is how we limit tax risk more than how we make an absolute tax saving. When you've got a corporate manager, all individuals will be caught by the employment-related securities rules. You will receive these units by reason of your employment. The taxation consequence of this is well known, if a little complicated. They've been around essentially for at least 11 years, and in some cases much longer. But there is a very different tax consequence between actual units that vest later and options over units. So with units, we have tax consequences at issue. But there may be longer term benefits if you're a reporting fund or you're a non-dom taxpayer, and we can get the units in an offshore fund. But one of the problems is that there's a tax consequence at issue. And if it turns out you haven't got the money because you've left the firm or the fund performance isn't there, you've still got a tax consequence. Options may be more attractive because while they will be taxable as income, they're only generally taxable on exercise in the language on vesting. So if that's the case, you'll never have this dry or wasted tax charge. So looking a bit more at units. If you pay market value at award, then there's no tax issues. But as always in tax law, it's a little bit more complicated. The rules look at both restricted market value and unrestricted market value. As the name suggests, where the market value is lower than it otherwise would be because of restrictions, that's restricted market value. And you end up, and as long as you pay restricted market value, there's no immediate tax charge. If your unrestricted market value is greater than restricted, and you don't pay full unrestricted market value, you can have longer term tax issues. This is unlikely to be a problem for AIFMs because in almost all cases we see any units will be issued at the same value as with external investors, so the unrestricted value. Even if there is a fee-free class of managers, you do need some special rights and powers in to deal with these restrictions. That's easily achieved, and if that's the situation you're in now, you've almost certainly got those rights and powers already inherent in the arrangements. Where you've got, when they come to vest, either 3 or 5 years later, there's no further tax. There may be a tax on the gain, which is depending on the nature of the fund. It might be income or capital. It might be offshore, so you might benefit on a remittance basis on any gain if you're non-dom. If there's any losses, it'll be a capital loss irrespective of the fund type, which may or may not be easily used depending on your circumstances. Corporate manager will get a corporation tax deduction for the cost of shared issued, or cost of options, and there will be employees NIC payable on anything that could be remuneration and the value of the options. With LLPs, and indeed partnerships generally, but everybody this will affect will be an LLP, LLPs are transparent for tax. They are not themselves a tax-paying entity. It is the members and the partners that are the tax-paying entity. What that means is the partnership itself doesn't pay tax. So all profits have to be allocated to the partners. And following the recent changes in LLP taxation, you cannot use a corporate partner, a corporate member, to facilitate deferral in this regard. People used to a very, very, very great extent. That's been stopped. So what's the problem? Well, if profits are allocated, then it's taxable. But if you were to defer a significant chunk of your remuneration, then you may pay tax on more than you currently receive. The FCA, HMRC, the representative bodies have come up with a solution where you can elect for the LLP to be allocated that member's share. The LLP will pay tax at full rates, currently 45% on this, with no reliefs and no allowances. That election must take place in 6 months at the end of the accounting period that it first applies. So presumably December 15, December 16, if it becomes relevant for you at that time. And on vesting, if these units vest at value, then the tax paid by the LLP is available as a credit. To the extent that there may be a loss on the units, then the tax paid is also lost. If, for example, you leave the manager, so your units are withdrawn, allocated to somebody else, that tax that's been paid isn't available to transfer anywhere else. But it also means that if somebody else receives these units, because they've got to go somewhere, then the other member that receives them doesn't have a tax charge. There's no tax on the recipient. So the rules, as I said, are complicated, but apart from the LLP changes, they've actually been around for quite a while. And there may be some opportunities for firms to consider exactly how they want to operate going forward. Should they be an LLP? Should they be a corporate manager?
Thanks, Lance. Perhaps we'll pick up some of those in the discussion points earlier. Okay, what I'd like to do now is turn to Malta. And Adam's been patiently waiting on the line from Malta to discuss Malta as a possible location to base funds within the EU. In fact, it's been talked of as a potential alternative to European fund centres like Ireland and Luxembourg for some time. So, Adam, is the way the Malta is implementing the Remuneration Code, is that providing a good opportunity for Malta? Perhaps you could explain how Malta is implementing the code.
Yeah, sure. Essentially, just a bit about Malta. For those that don't know, the MFSA, or the Malta MFSA, is the sole regulator, and it transposed the directive, the AIFM directive, in July of last year. And hence, as one would expect, most of the rules, the same rules that apply to FCA would apply to the MFSA and Malta rules. As you have on the slides here, essentially, you can find all this on the MFSA website, but Part B3 applies specifically to the AIFM managers, and there's a specific appendix on the remuneration policy, which is obviously particular here, And there's also guidance notes from MFSA on the MFSA website as issued in Q1 of this year. Moving on to the next slide. Again, as one would imagine, given that it's the same directive, most of the rules that Bobby mentioned earlier today apply also to the Maltese entities, and hence, just to mention a few, one would also require remuneration policies and procedures. The same would apply for Remuneration Committee, that's for the AIFMs. Identified staff, the same type of staff would be considered identified staff for the Remuneration Code by the MFSA. Again, the same type of remuneration, the definition would probably the same would apply for MFSA. Both fixed and variable obviously are covered in the Remuneration Code, as one would expect. The same important matter applies. One must ensure that whatever structures one puts in place doesn't come across as evading the Remuneration Code. That said, obviously, even as per FCA, dividends and pro rata returns should be excluded. And the same principles apply as the FCA for the proportionality principles, although the slight changes I'll talk to in a minute. And also the disclosure requirements are the same. Moving on to the next slide. A couple of things which are different, the last one in particular, but just going through them. Again, the size criteria for defining the proportionality principles are slightly different for the MFSA. For levered assets, a portfolio of less than 100 million, both the payout process and the Remuneration Committee are automatically disapplied. For the portfolios between 100 to 1.25 billion euros, they should be applied, but one can apply for derogation based on proportionality for both payouts and Remuneration Committee. And above 1.25 billion, again for levered assets, the full ESMA guidelines should apply. For unlevered, a portfolio of less than half a billion, both the payout and Remuneration Committee would automatically disapply. For those between 500 million and 6 billion, again the same would apply. You could possibly ask for derogation of both the payout process rules and the Remuneration Committee. And above 6 billion, the full application of ESMA guidelines should apply. Also, a slight difference again to mention, an AIFM in Malta need not apply the payout process to its employees who are considered key employees if both of the following apply. The variable remuneration, so the bonus essentially, of the individual does not exceed 50% of the total remuneration, whereas my understanding in the UK is it needs to be 33%. And similarly, the total remuneration of the employee does not exceed 600,000 euros, which essentially is the same as that of the FCA, or close thereof, for £500,000 sterling. And then to the last point, which is the most interesting, the MFSA have made it very clear that they will not apply the relevant section, so section 18 of the ESMA guidelines, which essentially restricts the Remuneration Code to the AIFM. So moving on to the next slide to give you a couple of examples. A typical scenario where you'd have an AIFM in Malta, and typically one would delegate the portfolio management to, say, a UK manager and retain the risk management. As we all know, to be an AIFM you need to keep either risk management or portfolio management or a bit of both. But the typical scenario is that the risk manager and management function will be held in Malta, and one would delegate the portfolio management to the UK firm. If that's the case, the UK firm will be considered to be a MiFID firm, and hence, as I mentioned before, the MFSA would not look through and not required to look through, and hence the Rem code would stay at a Malta level and a Malta Manco, and the UK firm would continue to apply the current MiFID rules. And then any, obviously, remaining profits in the last bullet point here would, as normal, be distributed by way of dividends, which, as we mentioned earlier, would typically be excluded of the Rem code. Another example in the next page would be for a US manager. Again, the same applies. You'll have a Malta AIFM. Malta AIFM would retain the risk management typically and delegate the portfolio management back to the US manager. And again, the MFSA would not require one to look through and hence apply the REM codes strictly to the Malta ManCo and not look through to the US firm, and hence the US firm will continue applying whatever rules it currently applies. And the same applies to the profits. That's it from my end. Obviously happy to answer any questions. I don't now step away.
Thanks, Adam. If you can, please feel free to put questions through. We've got plenty lined up for a few lined up for Bobby at the end, but I'm sure Adam and Lawrence will be happy to take questions, any questions you've got regarding tax and Malta specifically. Before we go to those questions, I just want to turn our discussion onto what we feel the Remuneration Code doesn't say. Now, I just sort of asked some people in the panel to comment on a few points I'd like to raise with them. I think we've seen, Bobby, much in the press lately about the unfairness of bankers' bonuses. Press comments in the UK about shareholder criticism of Barclays, I think it was, over its Manchester United-sized bonuses for Colchester United performers. But when it comes to alternative funds, your slide did mention a potential investor interest in this. How likely are you think investors are going to be in a fund manager's Remuneration Code compliance?
Well, in my experience, which really means from what I've seen from our clients, what I understand from speaking with our clients, this topic so far has not really generated specific or particular interest from investors in some of our client funds. I think maybe perhaps professional investors may be more attuned to some of the challenges that the AIFMD code, particularly the payout process rules, may represent for managers, but still, nevertheless, one would assume they would be very interested to know how managers ensure that their practices are in line with the investors' interests. It's interesting. The CRD Rem Code was the Capital Requirements Directive Remuneration Code, which was originally introduced for bankers, and then sort of found its way working across all sectors of the financial industry. That was originally framed in a prudential perspective, and really looking at the preservation of the management company's balance sheets, whereas the AIFMD pursues a more intimate aim, if you like, of aligning the interests of the manager with the underlying investor in the fund. And of course, that would, of course, one would assume, be of natural interest to prospective investors. So, as I say, as far as I understand from my clients, it's not a particular point that's been raised. It doesn't feature in template DDQs that managers often complete as yet, the specific question of remuneration. But I would imagine at some point investors will become attuned and alive to the question of remuneration.
Until they do, though, is there a risk that sort of supervision of the Remuneration Code by the FCA, that will be more about process, how they actually do the sort of benchmarking of their circumstances to the payout process requirements, rather than actually any elements of trying to control the risk that a fund is taking?
I think that's fair. At this stage, it's difficult to foresee the approach the FCA might take. A natural way of reviewing the implementation of the AIFMD in general and these specific requirements would be a thematic review, for example. And in terms of whether or not that might come to anything, we had a question before about whether or not this might lead to enforcement action. And that's difficult to foresee unless something is particularly egregious about the application of the rules here. I think it's really important to understand, or rather important to state, that whatever approach a firm takes, the rationale should be documented. So should they ever be challenged, they have a reasonable and reasoned response to whatever approach they've taken, and ideally a documented one, which is a very popular refrain from all consultants. But consider your approach very carefully, make sure it's documented, and be prepared to argue the stance you've taken if you're challenged. To date, as far as I'm aware, the FCA has not proposed, not suggested that it intends to do any particular reviews as to the implementation of the AIFMD in the UK, but that's not to say it won't happen. Of course, one would think it should really at some stage. But again, just to repeat, it's very important that you rationalise and document your approach and be prepared to argue it.
And politically, in 3 years' time, it might be difficult to say it hasn't done a review of the area given the nature of the subject. Adam, can I just turn to you, because we've been conscious, I think, since the presentation in terms of the SDA, they've been tried hard to come up with guidance that gives managers sufficient scope to justify disapplying the code. And as you mentioned, Malta too is applying rules that appear to be calibrated to just a bit more generous than the SDA, perhaps potentially to highlight Malta as a base for establishing EU funds. Could you just talk about the rationale for the Malta supervisors in allowing that degree of flexibility in their interpretation of the code?
Certainly, in my view, essentially, it's very much dependent on taking a look at the current type of managers that we currently have in place here in Malta. The average size, let's say, would be between 2 and 5 billion. You can get about 5 billion. And not to say that's a small fund, but there are quite a few smaller than that, so smaller than the 50 million mark. And hence, obviously, the MFSA is trying to be pro-business at the same time, but obviously abiding by the rules, and hence having spoken to the vast majority of the fund managers in Malta, it felt that the way it structured itself would satisfy nonetheless their requirements, their investors' requirements particularly, and obviously abide by the ESMA guidelines as well, because one, as we all know, one can apply the guidelines appropriately based on proportionality and law. I think the point you mentioned here, it's based on proportionality, essentially, that I view that MFSA made their call. I think it makes sense with the current structures that one has in place in Malta and the potential for similar structures with the examples I gave before. And I think it suits Malta fine.
Is it something that could be challenged as the process is reviewed under the AIFMD by other national regulators, or do you think it's sort of safe in terms of national regulators applying their own rules, that's unlikely to be challenged?
Yeah, so obviously that question was passed around in Malta quite a few. As we all know, every regulator is a regulator in its own right, and hence for any other jurisdiction to question that, I guess that jurisdiction regulator would be questioning the MFSA, which I'd be very surprised to. Having said that, my understanding is there isn't anything currently prescribed in the directive should there be an issue between, say, two regulators or two jurisdictions and how that would be satisfied, but one assumes that it will be raised to ESMA and ESMA would kind of give their guidance accordingly. But again, as I mentioned before, because this had been discussed in some detail, the MFSA has the right to make certain decisions based on the guidelines, and it's stuck to the rules. So it's not breaking out the rules. It's just applying them as it deems appropriate given the circumstances in Malta. Now, obviously, in 10, 15 years, if Malta becomes another Luxembourg, then one will have to see how that applies. But that's hopefully quite far away, and we'll still have to go through quite a few deadlines on the timeline of the AIFM directive in any event. But at this point in time, I do not anticipate, or I have not heard of anything that the statements made by the MFSA would be challenged across the jurisdictions or by ESMA for that.
It's also, to some extent, I guess, getting used to a new process, because this is a new environment which is effectively being implemented or start to bed down. But of course, Lawrence, tax has been with us for some time, so what would you advise more generally in terms of tax planning purposes for this dealing with AIFMD remuneration?
Tax planning, unfortunately, isn't all about saving tax. A lot of the time it's about understanding where tax will fall. And one of the key issues with all this deferral is understanding when tax may fall, what are the upsides and what are the downsides. You may decide that it's actually best to have a certain tax charge when you know you're getting money at some time in the future, rather than a potential tax charge now on something that you lose. And each individual business and manager needs to consider that for themselves. One thing that is interesting is, as John said, is this is all new, and the new HMRC partnership rules are all new. So we're still working through, and we'll be working through for some time, the consequences of both new sets of rules. One opportunity that may be there is where you run through an LLP in the UK and you've got a non-resident partner. If that non-resident partner was allocated remuneration as a deferral and they're taxed as a salaried member, then they're not taxed in the UK because they're not carrying out work in the UK. If sometime later they were to lose that money because they left the partnership or their performance wasn't there and it was reallocated to UK resident members who weren't employees, proper partners, then that may be something that actually becomes tax-free for the remaining members. It's an interesting nuance, and it's one that will cause some debate over the next 6, 12, 18 months, but we won't see exactly how the law will be enacted when it comes in at Royal Assent in July.
Okay, thanks, Lawrence. I think that probably gives us a bit of time now just to move on to some of the questions that have come through. It's still time to put questions through if you have them. For Bobby's benefit, a lot of the questions fall on his plate, but I'm sure that Lawrence or Adam will be able to sort of chip in appropriately. But the first question that came in quite early on in the discussion, I think this plays to the payout process application rules. Firms probably, I'm suspecting from a largish group, where the directors, the CF1s on the regulated firm might well be senior staff within the investment arm of the business, but they have wider responsibilities, such as insurance responsibilities or healthcare responsibilities. And the question's been asking, can those individuals be disapplied for the code? I wonder, Bobby, if you could comment on that.
I think it's important to understand, firstly, that the extent to which those, I understand they are CF1s, so of course, by definition, one would assume they have a systemic impact upon, they have an impact on the risk profile of this firm itself, if not the funds. So one needs to understand if they do play a part, strategic part in managing the business, whether or not they have any impact upon the management of funds themselves. If they do, then one can still apply. If one would need to understand how much of their time, so one comes down to a simple apportionment of time and resourcing. So if they spend a quantum of, say, their working week on AIFMD business and the rest of it on non-AIFMD business, one can consider apportioning their time in that manner. So consider, just repeat, if they have a systemic impact upon just the manager itself or the funds. Secondly, consider how much time they actually spend, physical time, doing work on AIFMD business, and then compartmentalise your application that way. If it's clear that they spend, a significant amount of their time on the AIFM and AIFMD business, then I would have thought this application of the rules is not prudent. But if you can argue that their impact is limited in terms of their impact upon the funds that are managed, and the proportion of time that they spend on AIFMD business is less than, say, rather is a minority time spent on there, then one could present an argument for disapplying those rules.
So of course, there's also the governance argument that if they're directors of the board, then they are part of the governance function. As you say, they're therefore part of the risk management of the entity. And I think in some of the groups that I've sort of seen with a legacy issue, or perhaps certain people appointed directors of the board, they're not necessarily the drivers of that business. So it might be the marketing arm, or it might be an investment management arm, and that somehow they're almost the wrong people to be directors. So I think it possibly plays this whole governance role again. The AIFM is an entity in its own right with its own risk responsibility, and they need to be demonstrated under the directive to the regulator.
Absolutely, yeah. So that may lead to a recalibration, again, to use that word, but again a reassignment of responsibilities at board level.
Yeah. Now in these groups, they may be part of a banking group, so I don't know if it is in this circumstance, but there may be that banking group be subject to the CRD code and remuneration. Would that need to apply two codes to the AIFM, the banking code and the AIFM code, or would the banking code trump the AIFM code within the group?
Strictly speaking, the rules make clear that adherence, firstly, the AIFMD, adherence to the AIFMD code would meet the requirements in SYSC 19A or C, that is the CRD or the MiFID code, or the BIPRA code, I should say. But if it's the case that the wider group is subject to the CRD, the FCA states explicitly that meets the effectiveness test. In other words, the CRD is deemed to be an effective and equally effective remuneration requirement and obligations as the AIFMD one. So if the rest of the group is subject to the CRD, that would meet the test. But I would still say the managers of the part of the group that manage the AIFM business.
Right, I believe we may be back on air now. Apologise for that. We'll have to find out why. Some sort of technical gremlins, which I probably can't blame the builders on next door for this time, but we'll try and get to the bottom of it. I think we were cut off just at the point around discussing performance fees and whether or not they alone would disapply the rules. And I think, Bobby, if I could just summarise what you were saying back there, was not necessarily look at the mix in the whole, look at the risk management arrangements. They may be an indicator of the payout process rules being applied, but not necessarily
in and of themselves.
And I think that's probably the case there. And then we had one final question which was put to us, which was in terms of disclosure. And obviously a lot of firms, we're going through the process of authorising a CPM IFMs, so they will be managing funds as well as managing AIFMs as well as other funds. So do these disclosure rules relate only to the AIFM elements? So I guess looking at someone's remuneration, split it in two, and only disclosing information around the AIFs.
That's exactly right. The disclosure here pertains to the AIF itself. So the disclosure is part of the annual disclosure requirement. As I mentioned in the slide, it can come with the annual report or be supplements to it, but it's to do specifically and expressly with the management of the AIF. All of the non-AIFMD business can be excluded from that disclosure.
Okay, thanks very much. Right, if there's any other elements Lawrence or Adam, you'd like to pick up from the discussion so far?
No, I think this will be the veritable moving feast. We will get more and more comfort with the tax rules over the next 12 months. People will be looking at what their peers are doing, which is the key element in all of this, and exactly how that's going to work. And that's going to come together such that we'll have the ideas will get more and more firmed up and focused over the next 12 months.
And Adam, have you found the remuneration issues particularly attractive to investors looking to locate to, sorry, funds looking to relocate to Malta, or is it sort of more of a package really that the location offers a sort of entry board into the EU market?
Yeah, it's a bit of both, I believe. You can look at it from a package perspective, as in why Malta. Happy to talk to that, maybe not on this call. But there's also possibly the remuneration. So for the larger fund managers, running 1.5 billion plus, then the Rem Code aspects and the Malta solution, if you wish, might be something of interest that we can explore. Obviously, like Lawrence mentioned, this is all new to everybody, so typically one should always look at it on a case-by-case basis, but the rules are set, everything is in black and white, and hence it's just a matter of applying the rules that are set in a particular situation. But yes, overall I think that Malta is very bullish, if you wish, as far as the positives that this might bring to the jurisdiction, and everyone knows it's not a too costly jurisdiction compared to the mainland, yet you get good value for money and all that. All the service providers are here, so I think it's a package deal together with possibly even the Rem Code that should attract people here for both funds and fund managers. But again, it's a look case by case, and I'm happy to answer any specific situations as they may be.
And I believe you may have got through that without mentioning the sunshine, which is excellent pitch for there. Okay, I think it's probably time to close out. When I was actually researching for this, a window email popped up on my email announcing the 25 richest hedge fund managers in the UK. And interestingly, the top 3 of those richest hedge fund managers themselves would constitute an in-scope remuneration hedge fund just by their wealth, their own personal wealth. So we know that remuneration is dear to many, many hedge fund managers' hearts. There's only 2 months to go now to get the Remuneration Code's policies drafted and completed to be in compliance with the AIFMD. And in the middle of between the 2 months in July, we'll be hosting a breakfast seminar on some of the monitoring challenges in relation to the AIFMD coming ahead. So thank you for your participation and the questions on the call today. Apologies for the slight gremlins that we have, but we hope it didn't spoil your enjoyment and information again from the webinar. And please proceed to complete your remuneration policies by 22nd of July. Thank you very much for today's call. Thank you. Bye.